Welcome to our viewers on EBNet Stream. This is Leon Craylan, and today I'm pleased to be joined by Nicole Agar, a portfolio manager at Truffle, one of South Africa's leading, or let's say upcoming, fund managers or investment managers. Nicole, welcome.
Thank you so much. Lovely to be with you all.
Great, thank you. I have been writing a column for EBNet in relation to the investment surveys that pension fund trustees, employee benefit consultants, investment consultants would utilize in assessing their investment managers. I found that those surveys tend to have a lot of information, and I would like to talk to you about specifically Truffle's participation in the surveys, the results that you have achieved on your equity fund, your South African equity fund, and where that has come from and what are the kind of statistics that trustees and so on should ultimately be looking at. So first of all, before we get into that, congrats. Your performance has been really, really good and really consistent, which is great to see. But I'm not certain all trustees in South Africa or even consultants actually know that much about Truffle. So if you wouldn't mind, could you just give us 2 minutes on the background to Truffle, as well as then your background at Truffle and what your role and responsibilities are?
Sure. So Truffle is over 15 years old now, and it is an owner-managed business. We do have an outside shareholder by way of IMG, but we are very much owner-managed, invested. We all have skin in the game. We all have shares. We started out, actually, quite a few of us from ex-RMB days, and we literally have sort of come together over the years. It is a team that has had a lot of experience and a lot of time in the market. It sounds Methuselah-like, but we've each got over sort of 16, 17 years experience if you just average us out. And I think what's very important as well is it's a team that has philosophical congruency and that we have the same investment philosophy. And that's very important in an investment team. It's hard enough beating the market without actually trying to, compete within a team itself. We very much work on a team basis as well. I am one of the members of that team. I am a CA by training. I have been in the market since 1997. And I'm one of the portfolio managers at Truffle, but we manage all our assets on a team-based approach. So it's not like my fund will look a bit different to anybody else's. But we also believe that all our portfolio managers should do research. It keeps you close, skin in the game, kicking the tires, sharing information. So I'm also responsible for some individual research of my own.
So when you say you have a team-based approach, are you responsible for the Truffle SA Equity Composite Fund, or are you just simply representing that?
No, I would say that the 4 PMs on it are responsible for the fund, and that's Ian Power, Saul Miller, myself, and Sophie Marie van Garderen. But that is also fed from a whole team underneath of analysts who also doing sectors, providing recommendations.
And what is the total size of your investment team now?
We over 16 people now. We've grown quite considerably, and we feel that we're at this stage, we're now at a sort of steady state.
And your assets under management in total?
We're at 100 billion. We reached that mark last year. It's very well split between institutional and retail. It's sort of more around 60-70% institutional, but we also split against quite a few products. But I don't want you to think that we have product proliferation. We have got 9 offerings. So we've got an equity, a balanced, we've got a local balance, we've got a flex, we've got a low equity, fixed income. And we're well represented in all of those. Our growth has come much to our great appreciation, largely from existing clients giving us more assets, which is a great vote of confidence, and we value that very highly. But we have also grown through traditional channels, DFMs, consultants, and everything. The markets have become quite complex, as you know.
So I'm not surprised that existing clients have entrusted you with more assets because your performance has been good and it has been consistent. And the two don't always go together. When you analyze the surveys and you look at manager performance, often you'll see performance looking good over certain periods but not over others. And that makes it quite difficult for the person analyzing to determine what do you look at and what don't you look at. And I always say to them, you need to understand and appreciate the performance in the context of the markets and the philosophy and approach. You mentioned that you're all very much philosophically aligned within in Truffle before you can actually understand whether the result is a positive one or not. But yours is interesting because it seems to have lived through the market cycles. So I'm quite keen to talk to you a little bit about that. So if I have a look at your equity fund over 3 years, I think it's ranking about 7 out of 47 or 48 participants in the Alexander Forbes Equity Manager Watch. Over 5 years, it's 2 out of 45, which is excellent. So can you comment on both your philosophy and approach, the markets over that time, and where this consistency has ultimately come from?
Sure. So I think the first thing to point out is that we are very much a valuation-driven house. We are a bottom-up valuation-driven house. So we are style agnostic. We are not growth managers or value managers, and we are not big macro top-down managers. This is how we're going to position ourselves for interest rates. We believe in going out and getting a valuation for each share. Which involves a whole process of research. It involves a whole process of getting out there. It involves quite a lot of prior experience to know what matters and when. But then what we do is our valuation methodology is consistent. So we can value a share in the insurance sector and compare it to a share in the banking sector and compare it to a share in a mining sector. And this is how the valuation methodology works. And then what we do is we rank our preference for those shares from top to bottom. So this is our valuation. The share price is higher or lower, and that will indicate whether it's time to buy the share or sell the share. And that is literally our guide to what we're doing in our portfolios. So shares at the top we would buy and shares at the bottom we would sell. But there are two things that I think Truffle really does well. One, we do have a very good process. But two, I think from so many years in the market is we spend a lot of time talking about downside risk. Where could we be wrong? So there's almost sometimes a bit of an absolute return focus in the way we look at things, because we found that you have just as much value to add by avoiding the losers as you have in picking the winners. And it's something that we have done well at Truffle. So that ability to always consider risk is a key factor. And then the second thing is we are quite agile. We have been in the markets a fairly long time. Our team has grown up with all of us and have been in the markets a long time now. And we have the intellectual honesty to say, what is the best thing for our clients today? What is a portfolio that is best for our clients today? And not sometimes when you're a young analyst, you think, I've got to hold on to my position because it shows conviction. And you get actually over that. You learn to believe, if the facts have changed, then we need to relook at it. So there will be constant reassessment of our portfolios. So at every day we will say, is this the right thing? And we will be asking, where could we go wrong?
Interesting. Every single time, well, I suppose it's every single time, or I think it is, I speak to a fund manager about their performance and those that have been successful. The concept of culture always comes into it. So the openness, the honesty, the rigor, the questioning of each other, the transparency through the process, ultimately, that is a consistent theme each and every single time. So it's interesting to hear that again. Nicole, you mentioned that there's a keen focus on risk and specifically the downside risk that your investments ultimately might expose customers to, which is interesting because that's giving me the understanding that there's a strong focus on risk mitigation within your portfolios. When I look at the surveys, I look at tracking error, one of the measures within the survey, and there your tracking error ultimately is higher than the rest of the industry. Not significantly so, but it is quite visible, if I could put it that way, both over the 3-year period, the 5-year period. So it's quite consistent that there's a higher tracking error. Now, to me, tracking error is around things like concentration, the kind of bets or exposures that you would take within the portfolio, and how different is your portfolio relative to the benchmark. So it's quite different to sort of absolute risk and protecting on the downside. So I'm interested in you just trying to explain that in a bit more detail on how you view tracking error within your portfolio. And ultimately, I believe that if you're not willing to take on risks, you're going to struggle to produce the return. And in your case, when I look at the tracking error, yes, it's higher, but your performance is higher. So when I relate that to information ratio, which for me is a measure of bang for buck, your information ratios look very good. So the risk that you've taken on in terms of portfolio exposure and so on have indeed paid off and are worthwhile ultimately taking on. But perhaps it could also mean that things could reverse. So I'm interested in your commentary around that.
So I think one of the first things I would talk about is the concept of conviction. And it's something we also spend a lot of time looking at Truffle. So whilst we might have a valuation for a share, we will also then consider what is our level of conviction in that share in order to decide the position in the portfolio. And that will involve quite a bit of scenario analysis. So we will be thinking, have you considered X, Y, Z? And then we will decide, are the risks skewed to the up or to the down? And that will inform our position sizing in the portfolio. Other thing I want to say is that it also depends on markets. So if you look at over the 5 years, we've had a lot of opportunities through COVID and through the war in Ukraine. There've been times when conviction levels lend themselves to being higher because you can see these opportunities and they're showing richly in the valuations. I would say at the moment, the conviction levels generally in the market are lower because we have so many things happening globally, geopolitically, etc. And you will find that at the moment, our tracking error is actually somewhat lower. So it's actually not something, a number we solve for. We build our portfolios and then we often think, oh, we'll look at the tracking error and say, okay, well, that makes sense because that is actually how we're feeling at the moment. But it's an example of the opportunity set, conviction in our calls, and also building down on risk.
Okay, so that's interesting. Do you have any strict maybe not the right word, but any rules in place around portfolio exposure, share exposure relative to benchmark? Any exclusions when you look at what's in the benchmark versus what you can invest in that sits outside of the benchmark? And how's that played out over the years based on that conviction as well? What type of levels would you be comfortable going to in terms of overweights or underweights?
Sure. We are benchmark cognizant. And we will manage to a benchmark that a client requests. We like the capped SWEX, but we are flexible around that. In terms of going our sizing around that, we would be guided again by our level of conviction. We also would be looking at some liquidity measures, such as you don't want to own more than 10% of a share. You want to be able to make sure that you can trade out of that share on time for a client. So that factors in it as well. And then the other thing that's quite important is looking at independence. I mean, we make good calls, but we don't make perfect calls. I mean, if we knew the one share that was going to outperform, we'd only own that share. So we try to make sure we've got diversification and independence. And we do that by we have our actually own homogeneous classifications of shares. It's not rocket science, but you'll find that all the sort of foreign diversified shares are in one place. So you've got BTI together with Richemont because it's actually driven by foreign stuff. And then Naspers and Processes are actually separate shares. And we found that these shares are more homogeneous buckets. And then we will look at our allocations and our weightings in the portfolio relative to those sectors because we feel that that helps control risk. We will be guided to some degree by how much of an overweight we will have relative to the previous volatility of the share. But on the whole, it's a blending together of levels of conviction.
Okay. And those limits that you spoke about, the 10% or whatever it was, how does that impact you? You don't want to own more than 10% of the company. How does that then impact you as your company grows? I've
Yeah.
always been interested in this with some of the other fund managers who have had exponential growth over the last 20 years or so, and how that's influenced both their philosophy and their ability to produce returns. So how do you view that?
So I would say that on the whole, fortunately, a lot of our alpha, and it's sort of been 4% on an annualized basis over the last 5 years, has come out of the big stocks. You've got to be able to get the big stocks right. That is not to say that we haven't had exposure to mid caps, and we have actually been exposed to the construction sector consistently for 5 years. This was a theme we saw coming, and we have actually had quite big ownership in Wilson Bailey Homes and Raubex. But as a whole, we will look to the liquidity to guide us, especially when we're looking at fairly complex situations. So last year, when we were going into the elections, we felt that assets were, SA Inc. was incredibly cheap, but we made sure that our exposure to it was in the more liquid shares, in the banks and in the retailers that were more liquid, because if it doesn't turn out the way you think it should, then you don't want to be married to a share forever. So I think we have traded in some mid caps. We've had some motors. We have been down in those levels, but we are very much aware that you do need to be aware of liquidity at certain times. So something like construction, you're less concerned about liquidity. We feel that there's quite a lot of growth to come for a long time.
And in that context, the lack of IPOs coming to the markets, in fact, many companies delisting and so on, how do you view that? I mean, is that a concern at all to you guys?
It's with sadness, although we really did participate very handsomely in the Boxer listing last year. And I think there is more interest potentially building. I know the JSE is doing a lot of good work there. I think if South Africa delivers on its renewal potential in terms of GDP growth, in terms of infrastructure build out, I think that things will get better. But of course, we would prefer more stocks to choose from and more liquidity, but we managed to do quite a lot with what we've got. I mean, at any time we're analyzing 80 shares and investing in about 50.
Okay, so let me ask the unfair question then. So given that and the optimism that you just mentioned there, a cancelled or postponed budget, a threat of tariffs and sanctions, where does that leave you in that respect?
So we definitely ended the year rotating out somewhat out of our SA Incs. We had done handsomely out of our retailers and our banks, and we were very aware of a world where the dollar was likely to stay strong, that this is not necessarily good for emerging markets. So whilst we still have exposure to the banks, which we think are cheap, we have taken profit in a lot of our retailers, and then we've cycled it into more of the offshore stocks that happen to be listed here, but that look compelling. So BTI, we actually had a lot in Richemont into these numbers which went, surprised on the US consumer side. And then we're more defensively positioned in AV, InBev, etc. The retailers have now come back some 20% and are looking interesting again. But it's not as if we held, and it again points to our agility, it's not as if we had held our SA Incs into the sunset. They had reached a stage on our ranking table where they were indicating they were now full value. So we took profits.
Okay,
In terms
good.
of the budget, I am an optimist. It's the curse of the optimist, but I feel that one also has to look at, one, maybe this brings a bit more fiscal prudence, and two, whilst very clumsy and not what you want to see, it also shows that the coalition are having to learn to work together. And I would remind viewers that France took a lot longer to get a budget through than this delay of a month.
Okay, good. So I'm glad to hear that there's still a light at the end of the tunnel. So that's positive news. Nicole, final thing from my side is we've spoken about your equity fund and the exposure and the performance on that. You also offer a balance fund that participates in the Global Manager Watch series under the brand or the banner of Ned Group Investments. Could you just quickly explain to me what that is and
Sure.
And how your equity exposure that you spoke about and philosophy translates into that balance fund as well?
So for all our multi-asset funds, and we run a flexible, we run a global balanced, we run a domestic balanced, all our equity, our best equity view is what you will find in those funds. So an equity carve out will be what you will see in our balanced fund that you are talking about there. The fixed income that you see in our fixed income funds is the fixed income you'll see in your balance. It is our best view. And because we operate as a team, this is our collective best view. This is what we're putting forward. And then obviously we have the global stocks, which we do a combination, but largely some stock picking and some ETFs and selected, like at the moment we've got an S&P 500 equal weighted, because we feel that takes out some of the risk that you're seeing in the Magnificent Seven. But because of how we are, we're a team-based approach. All our equity is what you'll see in all our funds.
Okay, great. All right, excellent. Nicole, first of all, congrats. It's fantastic to see, call it new names, but even though you're not new, time flies by very quickly. But it's good to see new participants, guys growing and performing well in the industry. It's ultimately value for the people that we manage money for. So congratulations on that, and long may it continue.
Thank you.
And I think it probably will, given some of the things that you mentioned around your culture and your team-based approach and so on. So that's very pleasing. So on that note, thank you so much for joining us. We really do
Pleasure.
appreciate it. To all our viewers on EBNet Stream, this is Leon Kraling, and thanks to you.